What's going on, everyone? This is Realtor Joe Samona. Thanks for tuning in to this episode of Your Cup of Joe. Today we have with us Emil Izrailov with Lake Michigan Credit Union. Emil, thanks for being with me today. If you want to introduce yourself to everyone.
Absolutely, Joe. It's an honor. Thank you very much. Emil Izrailov, Lake Michigan Credit Union. I've been a mortgage lender specializing in construction loans. Been doing this for 27 years now. I know I don't look that old, but serving Michigan, Florida, Indiana, Illinois, Ohio, and Wisconsin.
That's great. That's great. How long have you been with Lake Michigan now?
Actually, 10 years.
Wow. How long have they been around?
So Lake Michigan Credit Union actually started as Grand Rapids Teachers Credit Union in 1933 in Lloyd Hutt's basement. We actually have a scholarship to honor his memory. But yeah, and through evolution and of our membership, eventually they changed the name to Lake Michigan Credit Union because they started serving more than just teachers. But they've been around since 1933. So just like the Lions, we're at our 90th anniversary this year.
Great, except you guys have been winning since day one.
Yeah, 100%.
Right?
100%. Our members have been winning.
Exactly. For those that aren't familiar with credit unions, there's qualifications to become a member. I know some of them are you have to live, work, or worship in a specific state. Are the qualifications for a membership at Lake Michigan Credit Union similar to others where you have to live, work, worship in one of the states that you service?
Yeah, so those guidelines are set by whether it's a state or federal chartered credit union. Those are regulatory issues. So with us, you have to live, worship, or work in Michigan or Florida, which are two brick and mortar states. And then the surrounding territories, I think we have to make a $5 donation to the ALS.
Okay.
If we're not in that state physically.
Got it. For those that aren't familiar with construction loans, there's several different types of construction loans. Construction loans where the builder or developer is paid out at the end, and construction loans where there's draws. Can you tell us a little bit about what the difference is and what they're called?
Yeah, absolutely. So the most popular one is the one-time close construction to permanent financing. And what one-time close means is you close before construction begins, and your rate's locked in, so you don't have to worry about rising interest rates, right? So I have clients that a year and a half ago locked in, or a year ago locked in the fours, and now their house is completed, and interest rates are 7%, 6%, depending on what you catch, and they don't have to worry about that because they locked in the beginning of construction. So the way a construction loan works is it could be used as it could be in a purchase situation where you're buying the lot and having the builder, build your home. We pay out the lot at the beginning at closing, and we incrementally wire funds to the builder through a supervised draw process. That draw process, has certain elements of it. So we know that the builder's using the funds for your house and not somebody else's. So every time the builder submits a draw request, they have to submit several documents with it, one of them being a sworn statement. So a sworn statement is a line-by-line budget that identifies every contractor and every material supplier that's going to be paid. And there's columns. So when the builder requests for excavation, permits excavation foundation, let's say, in the first draw, the builder has to identify who's being paid and how much. We issue those funds. Now, when the builder comes back for the second draw, he has to provide lien waivers for those contractors or subcontractors and material suppliers. And a lien waiver is nothing more than a receipt from a subcontractor or a material supplier that says, I've been paid. We take those documents and we send them out to the title company and the appraiser that originally appraised the blueprints. That appraiser walks through the house and, looks for those things to be completed, sends us a progress report. At the same time, the title company goes through and validates all those waivers. They call those subcontractors and material suppliers and say, hey, we have a signed lien waiver from you. We're just calling to authenticate it. They say, yep. Once that happens, the title company issues an endorsement for that amount, and they send those back to us. Once our construction draw department gets those documents back, They look through it, make sure that the funds requested aren't too far ahead of the progress of the home, and they issue the draw. That whole process takes about a business, about 1 week, 4 to 5 business days, and then we release the next round of funds.
I've been a licensed realtor, although I've been around it since January of 2012, and everything is a learning process. Like today I'm learning a lot based on what you just told me right now. Now, regardless of the type of construction loan that somebody goes through, are you as the loan officer, are you involved in the process every step of the way, or do they kind of get not bounced around? Because I know how your service is, I know how Lake Michigan Credit Union service is, but are you kind of taken out of the loop at some point in the process, or you as the loan officer, do you stay in knowledge and in contact with the process?
Great question. So once, there's a separation of duties in lending, right? So I can't be the originator and the underwriter. And, so I originate the loan, we take it all the way through closing. Then our construction draw team, which is the best in class. We're the number one construction lender in the state, and it's because of our draw team. So they take that over, but I'm copied on all the draw requests. So I know what stage of progress my clients' homes are at. I know when there's an issue that comes up. Sometimes there's a dispute between the borrower and the builder, and we have to get involved. Not me personally, however, we're aware of it. That separation of duties keeps me out of it, but keeps me informed. So when my client calls me with a concern, I'm on top of it.
That's actually great to know, because some people would expect, oh, this lender is going to be part of the process the entire time and may not understand the process, but the way that you just explained it sets it out for the client, so that way there's no misunderstandings or misinterpretations.
Yeah. So with just with the draw process, the builders, when a builder, I work with a lot of production and which we call semi-custom, because there's really no production houses anymore, right? Everything can be customized, and I work with a lot of custom builders too. So what I like about our draw system is you're Joe Samona builder today, right? Well, you're not going to have the same draw specialist on every loan, right? Every one of your clients is going to be assigned the next draw specialist. So it does two things. A, it doesn't overload one draw specialist. And the most important part about it is, hey, you're not going to get too friendly with one of our draw specialists where they might say, oh, something, we'll let this waiver slide, right?
Yeah.
So integrity is everything. We're dealing in some cases with multi-million-dollar loans, hundreds of thousands of dollars on, you can't build a house for under $300,000 or $400,000 these days. So, we take that very seriously, and we're looking out for our member. Regardless of the referral source as the builder, our number one concern is our member.
Absolutely. And that's refreshing to know that, there's lenders out there that care about the members and don't just care about their end result, the profit in their pocket, which is the similar values and morals that I hold. Because to me, yes, I need to make a living, but at the end of the day, if my client's not satisfied, I'm not satisfied. And if I haven't done everything that I could to satisfy my client, then I'm not satisfied. One thing among many things that I'll commend you on is your ability to read self-employed income. And I know a lot of the deals that we have done have been self-employed income. Actually, I think all of them have been self-employed income, and not with just 1, 2, 3, 4, 5, or 10 businesses. We're talking about dozens of businesses. So that's definitely a challenge as well. You've built up a rapport with a huge builder, with Pulte.
Yeah, so Pulte Mortgage has their own, Pulte doesn't do construction loans. They do end loans. So Pulte, has their own mortgage company. But any mortgage company that sells all their loans has limitations of what their investors' limitations are. So with Lake Michigan Credit Union, we sell, we do the Fannie Mae, Freddie Mac, FHA, VA, all the standard loan products, but we also have the ability to portfolio a loan. And what that means is we fund every loan with our own money, but we have an opportunity to be the investor on the loan instead of having to sell it to Fannie Mae or Freddie Mac. So in a lot of circumstances where, somebody's been in business, but maybe self-employed for less than 2 years, we can make that exception where a Fannie Mae or Freddie Mac loan would have to have a 2-year history of self-employment documented by tax returns. Or, a situation where, in a divorce situation where Fannie Mae and Freddie Mac require a 6-month history of receipt of child support and alimony, in 36 months of continuance, meaning 3 years, that there's going to be a continuance of those payments for 3 years, sometime, and the client's depending on that income to qualify for the loan. Well, in a divorce situation, we see the joint filed tax returns for the last 2 years. So that's something that I could take to my credit committee and say, hey, we know this person can afford to pay the child support. And even though we don't have a 6-month history, this client needs to buy today. And we'll put that into a portfolio loan. And once the client seasons and can qualify for the agency guidelines, we'll present them with opportunities to refinance if it makes financial sense for them.
Got it. So that's kind of like a reverse of an overlay.
Yeah, exactly.
Yeah.
It's an exception. It's an exception to guidelines, and that's that's the beauty about being a portfolio lender in those situations. We can modify guidelines or make exceptions to in certain circumstances.
Got it. And for those of you who don't know what an overlay is, if Fannie Mae or Freddie Mac have a guideline saying you need 2 years of tax returns or 2 years of employment, a lender could have an overlay to say, well, we understand that's their guidelines, but we want 3 years. In this case, if based on what Emil just said, it's an exception. So it's the opposite of an overlay if you're familiar with an overlay.
Yeah, the most common overlays with some lenders is, you've heard that FHA doesn't really truly have a minimum credit score. They could be manually underwritten, right? So, but a lot of lenders put an overlay of a minimum credit score of 580 or 620, because they want to make sure that they're underwriting to a standard, right? So those overlays are very common. But yeah, every company has overlays, but we have the portfolio power to be able to make exceptions to certain guidelines. But it's got to make sense. We don't want to, as a credit union, we're funding these with member deposits basically. And the last thing we want to do is put our members' money at risk. So it's got to make sense, and that's what our credit committee's for. Our credit committee meets daily. So, if I submit a credit committee request today for a special exception, chances are it'll, be out today or tomorrow. Up to 48 hours, we get a decision on it.
You got it. In the last 3-4 years, since the market has boomed and since inventory has been lower, and naturally new developments are coming up, are you seeing an influx of construction loans?
Yes. So with, with obviously, if there's no houses to buy, the only thing you can do is build, right? So a lot of developers, are developing subdivisions, and we're happy to be their partner to help finance these new construction homes. And in my opinion, I think that, with limited inventory, becomes a bidding war, right? So you're bidding $30,000-$40,000 over the listing price just to buy the house. Well, this house has aging infrastructure, mechanicals, roofs, windows, right? So new construction is a better option in many of these cases, as long as there's new construction available in the area that you're looking. Because if I was going to pay a premium, I'd rather pay a premium on new construction than than grandma's house, where I have to go in and replace everything. So I'd rather pay a little bit more for new construction, have all brand new warranties and life cycles on appliances and roofs and windows, all the major components of a home, instead of having to bid over asking just to get the house and then have to go in there and replace all that stuff.
Got it. So, question for you. Right now, if somebody's building a home in a subdivision that a developer's building versus a, home that they just tore down in the middle of a subdivision, and they put, upgrades in there. They might put upgraded countertops. They might put more recessed lightings, more windows. They might put a sunroom in there. Is there a specialized, or are the appraisers that are appraising these new construction homes, are they vetted more thoroughly to see how they're going to appraise these? I've been in the business, like I said, since 2012. I've been licensed since 2012. I have more knowledge in it, but I have a little bit more of an understanding. But can you tell everyone listening, are these appraisers who are coming out telling the bank their opinion of value on the property, are they more vetted?
So, yes and no. I mean, all of our, we have an appraisal panel. We manage our independent appraisers directly. We don't go through a third party. But there are certain appraisers that say, yes, I do construction loans, and certain appraisers that say, I don't do construction loans, right? A construction loan appraisal, in my opinion, should be easier for an appraiser because they don't have to walk through a house and look for all the upgrades. Everything's spelled out by the architect on the blueprints, on the sales sheet from the builder. So it gives them a better idea of the upgrades. Now, the level of finishes on the interior, the exterior, that's when an appraiser makes an adjustment, right? They can only use the sales data that's out there that you and I see if we pull up comp reports. But their job is to bracket those and make adjustments based on size, based on quality, based on age. And most of the time, new construction appraisals come in at the price, somewhere around the price. But when you get into these super custom homes, where you want something so specific that we might not be able to find comps for it, so you're spending $3.5 million to build this house. Well, we might only be able to comp it out at 3.25. But for those people, typically it's not an issue to come up with the additional funds. And a lot of things on contracts, right? Like for instance, builders give allowances for certain items because you can't get an exact price. No vendor is going to give you an exact price for something that's not needed for, until 6 months down the road. They can't predict their own pricing. So they'll build in allowances. And in those cases, let's say you have a $40,000 cabinet allowance and it comes in at 45, the homeowner is responsible for writing that check for the difference.
Yeah, that's why homeowners who are building a home are encouraged to add all their upgrades that they want
Up front.
before the change order window closes out. That way, when it goes to the lender and it goes to the appraiser, they see all those and they're able to comp those out.
Yeah, and unless you're working on with a fixed price builder, right, and you don't make any changes, you should be okay. But but in most situations, you're in the process of building a house and you walk through a store or you go to, you go see another house or you go to somebody's house and you see something, you're like, oh my God, we didn't think of that. Why didn't we think of that? Oh, change order time, right? So, and again, those situations, the borrower has to come out of pocket on those change orders because we can't go back and change the loan amount, especially if you started with only 5% down. There's, no more room in the loan. So, but
Yeah.
change orders are typically funded out of the borrower's pocket.
One thing, Emil, that I want to compliment you on is your integrity. For those that have dealt with me, they know that I'm professional. I take my fiduciary responsibility to my client very seriously, as should all people. So the one of many things that I like about you is that you're a no BS guy. You tell it how it is, and obviously with being respectful to the client and to the agent, but you don't sugarcoat it. And that's one thing I commend you on. And that's one thing that's hard to find in many businesses, let alone this business, when this is one of the most exciting times of somebody's life and one of their biggest financial investments. They should be guided and not BS'd. And that's one thing I commend you for.
Thank you. Thank you. Well, and you said it, Joe, you know, integrity is everything in this, right? If I if I put my name on a pre-approval letter for somebody that I haven't vetted and I haven't reviewed their tax returns, you know, it's only going to reflect poorly upon me and then ultimately the referral source, because they're going to come back to you and say, why'd you refer me to this clown? He set me up for failure. I went and I put an offer in on this house. My wife got all excited. My kids got all excited. And then, you know, at the end of the day, we didn't qualify. You know, I can't put anybody in that position, right? Not you, not our customers. So for me, you know, if you do your homework up, take the extra time up front, do the homework, and then that way everybody's moving forward with confidence. And, you know, one of the other things, like when you present an offer, you know, you copy me on it. And I call the listing agent and follow up, and I tell them, I'm like, hey, I've done all the homework on these borrowers. That's why, you know, I signed that pre-approval letter. It's as good as gold, right? And what that does to the listing agents, and when that listing agent's presenting those offers to the seller, they're like, hey, you know, actually the agent reached out, you know, the lender reached out to me on this one and told me they've gone through all these steps with the borrower and have reviewed everything. And, you know, that sticks out to the seller because that just eliminates a lot of fears for the seller. Because, you know, how many times have you seen a transaction go to day 29 of 30 and then the lender calls and says, I'm sorry, we can't close?
I have. And before we wrap this up, I'll say I've had listings where clients, where the selling agent, who is the purchaser's agent for terminology, has said, we have a pre-approval, we don't have it in our possession. Our lender is out of town on his way back into town. Who's the lender? Emil Izrailov. I said, no need for the pre-approval. Emil, John Smith. Oh, he's great. He's working with Jane Smith. They're great. No need for the pre-approval. That's something that I'm able to confidently represent to my client. So, Emil, there's also interest-only payments. While somebody is building a home, there's interest-only loans. Can you briefly tell us about that?
Absolutely, Joe. So let's say you came to us and asked for a 30-year fixed construction loan. You get 12 months to build your home. During that 12 months is interest-only payments. Now, if you're building a custom home, we do have 15 and 18-month locks as well. However, during that construction period, you pay interest only based on how much has been drawn to the builder, not on the entire loan amount. So you have incremental payments based on how much has been outstanding on the draw. So if you only have $100,000 at 6%, that's $6,000 divided by 12. You're paying $500 a month for every $100,000 at a 6% interest rate. So in those payments, progress payments happen until the loan converts. Once the house is completed, we've executed the final inspection, the builder submitted their final draw, the loan converts to a permanent mortgage. There's a couple of documents you sign, no additional closing costs, and the loan goes into your amortized payment with principal, interest, taxes, and insurance.
So if you're doing a construction loan with draws, it's similar to a line of credit where you're only paying on the money that you have used so far. So if the whole loan is $500,000, you're going to be paying and you draw $125,000 at a time. The first draw you're only going to be paying based on the first $125,000. After the second draw, based on $250,000.
Correct. It works just like a line of credit until the home is completed, and at the time of completion, we convert your loan to the permanent financing.
Got it. That's great information. Everyone, thanks for listening and tuning in for this episode of Your Cup of Joe. Stay tuned for the next one.
Thanks for having me, Joe.
Thank you.